All right, good afternoon. Thanks for joining us. This is the Growth Stock Guru Show. I am your host, Rick Action Jackson. It's Thursday, July 1st, and we just finished the second quarter. The S&P was up 6% for the second quarter. That's the best quarterly performance for the S&P in over 10 years. We're in a rip-roaring bull market. This is a Wednesday. I let people email me or text me a stock they'd like me to give my 2 cents on, and I'll tell you whether or not it's a stock that would be considered a stock my strategy would potentially buy or why it wouldn't, and then I'll also comment on whether this is a good investment or one I would stay away from. So our first request is CVS, the drugstore chain. This is from Liam in South Carolina. CVS is trading right now at 104.39. It's had an interesting run. It was under $60 just 11 months ago, and now it's up at 104. There's a lot of things that have gone right here with this company. One thing that we're very tight and concerned about is how have they done on forecasting earnings and then delivering better than that. And CVS has had a great run here for about a year and a half now. They've been beating the expectations every quarter. But I wonder how easy this is going to be to continue this because Walgreens and CVS have had a great year, and I think a reason for it is that Rite Aid, which was the third largest drugstore chain, went out of business. They borrowed too much money, and they had some losses, and so they closed down all their stores. I don't know if where you live, Liam, down in Charleston, South Carolina, if you see many Rite Aids, but in the neighborhoods I'm in here in the New York area, almost every town has two drugstores. One of them's a Rite Aid, one of them's a Walgreens, one of them's a CVS. Obviously, if your competitor in town goes out of business and you're the only drugstore left in town, you're probably going to have a pretty good year, and that's what Rite Aid has done. The question is, can this company continue to do this into the future? I'm skeptical. They have beat the numbers every quarter for the last 6 quarters. The stock is no longer cheap. These drugstore chains, when their earnings are flat or they're missing their numbers, they tend to trade around 8 to 10 times earnings. And when things are going well, they'll trade at 15 times earnings. So Rite Aid, CVS right now is expected to do $8.30 in 2027, and it's trading at about a 14 multiple, and it's up almost 90% in the last 11 months. I would say the odds of it going up another 90% in the next 12 months is very low. So I'd be inclined to take the money and run here. It's not a terrible stock. It's got a decent balance sheet. It's got a good business. But historically, these companies have needed something, some new product, some new reason to go into the store for them to maintain earnings growth in the double digits, and that's what we want. We want people that are growing 15% or better. I think this is a 1 or 2 year thing with Rite Aid getting out of the game. And sooner or later, there'll be a new number 3, and Walgreens and CVS will get back into price wars. And, they're also competing with Costco. They're competing with Amazon. Hard to see how they're going to maintain this level of growth. So I would take the money and run on CVS. Next, we have Michael in Boca Raton, Florida. Michael wants to know about Delta. Buy, sell, or hold. He said he bought this stock a couple years ago, and during the the lockdown from COVID-19, and he's done very well. Delta's near an all-time high here. It's, in my opinion, it's the best-run airline in the world. They tend to dominate the high-end business class flyer. They're known for having better service than most of the other airlines, although that doesn't say much. But they are very good at identifying who their frequent high-end flyers are. People will pay business class or first class, and they do pamper the hell out of them. but there's only so many people in America that will pay those rates. And it's not really the uber wealthy that do it. The uber wealthy have their own jets. And that's becoming more and more common because you can lease jets now and share them with other people, which make them much more affordable. This is more the upper middle class. Delta may be able to pull off continuing to do this, especially as we got a good bull market going on, and the upper middle class tends to participate in the bull market. But it's selling at about 15 times earnings. And I think Warren Buffett's a lot smarter than me. He 4 times in the last 40 years has tried to make money on an airline stock because you would think it'd be a great business. There's a big moat. It's limited competition. There's a limited number of gates at the airport. But the costs are high. They have very high union labor costs, and they also have very high equipment costs. Boeing jets are not cheap, and they cost a lot to maintain. So let's go to the chart on this one. You see here over the last year, it's had a great run. It's gone from 55 up to 93. It's at an all-time high. You go back and look at 5 years, it's way above where it was. Now, are their earnings that good? They're okay. But they're selling at about a 15 multiple here. Their earnings are in the neighborhood of $6 this year, $7 next year. Airlines typically sell at 8 to 10 times earnings and 1 times revenue. Delta here you got at 1.5 times revenue and 14 times earnings. That means it's going to be limited to the growth of its earnings because I don't think the multiples are going to expand much further. And this chart is definitely overextended, which means it hasn't had much time trading at this level. So the first time it goes down, it's going to be tough to see where do people step up to buy more of it, or where do the people that missed the run decide to step up and buy it. This stock might pull all the way back to 65 or 70 before it finds good support. I would take the money and run on Delta, Michael. I know you've owned it for a number of years, and if you bought it in 2022 or 2023, you got it in the high 20s, mid 30s. You've made your money. Take your $93 and thank your Lord and move on. Okay, next one's the toughest one I've got today on my list. This is Stu in Cambridge. He said Intel. He owns some. He's thinking of buying some more. Buy, sell, or hold. Intel was one of my favorite stocks of the 90s, and I used to be a semiconductor analyst. And I really thought Pat Ginslinger, who took over as a new CEO about 4 or 5 years ago with a great turnaround plan, was going to bring Intel back to its glory. And he didn't. He also wanted to take Intel from making chips just for Intel to doing third-party business. Now, Taiwan is known for this, but the Koreans and the Japanese do it too. A lot of the Far Eastern semiconductor manufacturers, they're very good at manufacturing. They're not very good at innovating. So what they do is they let the Americans innovate, but then when the Americans have the chip that they want to mass produce, they'll mass produce it for you because they can do it cheaper and they can get the factories up and running quicker than we can. They have less environmental and regulatory issues, and they have a lot more capacity. So America used to make all of its own semiconductors when it had 80% of the world market in the 80s. Now, less than 10% of the chips we consume are made here, and they're all made by IBM, Intel, or Micron. Everybody else sends their manufacturing overseas. Now, the president succeeded in getting a lot of these companies to open new factories in Arizona and New Mexico, but I think once they're all up and running, you're still going to see half the production come from Asia. That being said, Intel just landed its first 3 contracts as manufacturing chips for other people. They're going to manufacture chips for Apple, they're going to manufacture chips for ADM, and they're going to manufacture chips for IBM. Maybe this whole thing of them manufacturing for other companies will work real well. There's about 50 semiconductor companies in the world, and 35 of them send their manufacturing out to Asia. But it's not a cheap stock anymore. They have beat the numbers the last 3 quarters. Their new CEO is very impressive. He's been in the industry for 30 years. He knows it well. He's an engineer. His name's Hock Tan. He's done a great job turning this company around. But it's no longer cheap. When Intel's not doing well, it tends to bottom around 2 to 3 times revenue. When it's doing fairly well, it tends to be around 5 to 8 times revenue. It's at 12 times revenue right now. They're not making a lot of money, but they are making money. They were losing money for years. The big hope here is that the next generation of NVIDIA chips are going to have a CPU next to every NVIDIA chip. Right now, there's about one CPU or the chip that Intel is known for. They created it, the microprocessor. There's about one for every 4 NVIDIA chips. It's going to go 1-to-1. So the demand for these chips are going to double. The microprocessor is very good at doing mathematical computations. The NVIDIA chip is very good at searching data and using algorithms to make predictions or create content of, like a literature content. So could this go a lot higher if Intel gets a big percentage of the market share of these extra chips NVIDIA needs? Yeah, it could. But Intel's new to being a third-party manufacturer, and this is not an easy business. There's a reason why only 3 or 4 companies in the world do this. They have any hiccups, any setbacks, any quality problems could really impact their revenue growth and their bottom line. Right now, the stock market's expecting them to double their revenue in 2 years. If they do that, the stock will be a cheap stock. It'll probably be worth somewhere between $150 and $180. But this stock is up from $25 in 11 months. It's at $128. Sometimes you hear the president bragging about it because he invested $10 billion of the government's money into Intel to help finance the building of new factories here. And he loves bragging that he's quadrupled his money in 9 months. Well, it's not going to quadruple again the next 9 months. Could it go up another 50%? Maybe. I'm not a buyer here. I would tend to take 1/3 to 2/3 of the money off the table, but I probably would let 1/3 to 2/3 ride. And deciding on whether it's 1/3 or 2/3 will come down to how big a slice it is of your portfolio. And this show is not financial advice. It's education. You make that decision with your financial advisor. But I'm not against taking money off the table. I'm not against leaving some invested, but I would not be buying here. I need to see more success on these new fabs that they're opening up because these fabs cost $20 to $40 billion to build, and they take 6 to 18 months once they're built to build enough volume to pay for themselves. Intel's got a long way to go to get there, and my thought is they'll probably have some hiccups. I'd rather buy it on a hiccup when it's $20, $30 below its all-time high than within $5 of its all-time high, and it's gone up 400% in a year. That means there's a lot of people out there own the stock that have profit they're going to want to lock in the first time there's a sign the stock's melting down. Would not be surprised if we get another chance to buy this under 100 down the road, and there I would be very interested. Okay, so I hope that answers the question for you, Stu. Next one is HIMS. Let's take a look at this chart. This one is a good chart to take a good look at. This company's had a hell of a bumpy ride. Oops, that's the wrong ticker. That's HIMS. HIMS. This company, if you never heard of them, Him and Hers Health, they got kind of famous because they were willing to prescribe both these weight loss drugs and they're willing to prescribe sexual enhancement drugs. And the doctor that prescribes them is right there at your gym. Take you a 5-minute conversation. You've got a prescription to pick up at Walgreens or CVS on your way home. The concept here is complete and total wellness. These guys have, a Slurpee or shake lounge or, when you do a health shake with the fruits and all that and the proteins. They advise on diet. They advise on health. They have a doctor's office there to get a very detailed physical whenever you're there. They encourage you, if you have any type of heart or blood sugar issues, to wear an Apple device or some other company's device so that they're constantly getting updated to your health status. This is hands-on, white glove wellness advice. How many people do you know out there are going to pay $300 a month for that? Their very first one was in Princeton, New Jersey. Their second one was in Cambridge, Massachusetts. If either of you know anything about those communities, they are the perfect demographic for this concept. My experience is most Americans want to be healthy. Most Americans want to be thin. But the day you make them pay a premium for that, you lose a lot of people. And this company has had a lot of problems because the FDA had issues with the way they were issuing prescriptions. And, they didn't feel the 5-minute doctor conversation was adequate. And they've had a hard time getting discounts on the fat drugs, although they have managed to work out some better deals. They are getting better pricing on them. But they need, if this is going to become a $60 to $100 stock, which is what you want it to be if you're going to buy it here at 37, they need to double or triple their locations in the next 5 years. I just don't believe there's enough demographic areas that will pay $300 a month. Now, granted, you get other things with that, and they'll take your insurance payment from your health insurance company for your physical, and they find ways to integrate the gym membership with your healthcare plan, but they don't tend to give you much of a discount for that. They'll give you a small discount. They pocket most of that reimbursement money. It's a great model if you can find enough Americans willing to spend that kind of money. I think you will find the next 2 generations doing that. They seem more focused on health, but they're not going to do it now in their 30s and 40s because they're healthy and they don't have a lot of money. Let's face it, the baby boomers eat at McDonald's twice a week. These are not the most health conscious people. I don't see this becoming a big national chain like LA Fitness. LA Fitness had it priced the right level, I think there are a lot of people who pay $100 a month for a premium gym. I doubt there's a lot of people who pay $300. I could be totally wrong. If you believe there are, then hold on to the stock here, and I would even buy it if you believe that. But I think this is a recovery. The stock was way oversold down in the teens in February and March. But I would stay away from HIMS, HIMS. And lastly, let's go with Meta or Facebook. We have Sarah in Norwalk asking about it. Should she buy it here? I'm going to tell you yes, Sarah, even though it's up $52 today. Let's go to the chart. This stock has had the hell beaten out of them, yet they continue to blow everybody away on the earnings they make. So it's been a catatonic ride this year. The stock spikes up when it reports great earnings, and then it spikes down when they update Wall Street on their amount of capital spending. They want to be one of the primary data center companies in America. Facebook by far has been the most successful company in America using artificial intelligence to target their ads at the right people. They're way ahead of everybody on this. You've got 2 problems here with Facebook. The first thing is that they're pretty much an advertising-only company. And I don't care how good you are at what you do, advertising is a cyclical business. When companies start to experience downturns, they'll always cut the advertising budget before they start laying people off. They don't want to lose their people if they can afford to not do it. They'll cut the advertising first. Now, so far in the last 2 advertising recessions, Meta or Facebook successfully grew through them, although they only grew at 15 to 20%, and they've been growing 30% plus most of the years. But they're still cyclical. So that gives people pause in giving it a large multiple. You get a large multiple on a stock when they can consistently deliver on the numbers. And Meta has. They've only missed 1 or 2 earnings reports in 10 years. But they're doing 2 things that are making a lot of people scratch their heads. The first thing is they renamed the company Meta because they created this new platform with Microsoft called the Metasphere. It's like the Matrix. You put on some goggles and you're in an artificial world, and you can do all kinds of artificial things. You can be a jouster, a knight in shining armor. You can be a villain that's stealing cars. You can do all kinds of crazy things. It loses a lot of money. It has the potential to be the most profitable business Meta has, because a weakness for Facebook is that they have to go through third parties to get to you. One reason why they've been putting so much money in the Metasphere is that this is the first time they're working on a platform that they don't have to pay anybody to get to, and they don't have to ask anybody's permission to get to it. They own the platform with Microsoft. So Zuckerberg has hoped, the founder and CEO of Facebook, that this would take off. It hasn't. But Wall Street has zero expectations it's going to take off. They've been losing $2 to $3 billion a quarter on the Metasphere for 4 years. It's almost like Wall Street doesn't even think about it anymore, because when they first started losing that kind of money, they were only making $6 billion a year. Now they're making $25 billion a year. $3 billion loss is not that big a deal. This business, I will predict, will go profitable within the next 2 years. Why? Because the U.S. Army has signed a huge contract with them. I'm amazed the stock didn't go up more when they announced this. The Army right now, with their battle-ready divisions, I mean, the Army's got, almost 1 million men in uniform. Only about a third of them are trained to be frontline soldiers. The rest of them are support or intelligence or all kinds of things the Army does. Those frontline soldiers do 2 war games a year. They're going to start doing 4 war games a year in the Metasphere, and it's going to cost the Army half the money they spend now to do 2 in the real world. You don't have to drive them anywhere. You don't have to spend the gasoline. You don't have to set up a place to eat in the middle of nowhere. You're at a desk with, goggles on and earphones, and you're fighting they're just training you to know, when do you cross the street when you're taking on a town? You should be checking certain windows for snipers. You should be checking the shooting angles so that when you cross the street, they only have 1 second or 2 to shoot at you. They're going to be training wartime tactics to their soldiers in the Metasphere. If you go back through time, most technologies go from losing money to making money by the military adopting it. And when these men get out of the Army, they're going to be used to it, and they're going to want to use it for other things in the free market. So I do think they're going to turn the corner on this. They've lost over $70 billion building this, but that $2 billion a quarter loss will go away, and that's pure profit. So right there, getting rid of that loss will bump up their profits $6 to $8 billion a year, and that's 20% right there. Why is it up so much today? They announced today that they're going to start offering cloud services to small businesses that advertise on their network. And they're spending most of their money to build data center clouds. Well, data center clouds rental rates are very high. Tesla just rented out a third of theirs. It's going to bring in $20 billion a year in rental money. $20 billion a year. So if Meta rents out a third of their capacity, they could very well almost cover half of their CapEx. So where do I come out on this? This company, you look at the chart, it's been all over the place. But on the earnings, they have consistently delivered. Let's go to the earnings. I should have this ready. Okay. Meta has consistently over-delivered. One thing they have in their back pocket is that the ROI on advertising on their platforms is off the hook. Most companies experience anywhere from 200 to 400% returns. I personally know several small business owners that advertise on one of Meta's platforms, mostly Facebook and or Instagram. And for $2,000 to $5,000, they bring in $50,000 to $200,000 in revenue. I mean, that's a dream. I mean, you know, the car companies spend millions on TV ads hoping to boost their revenues 20%. You can double your company's business for a fraction of that money if you're a small business. They know they can raise prices whenever they want to because, you know, if you're a small businessman and you're making an extra $100,000 in revenue by spending $3,000, you really think you're going to stop if you make it $3,500? So whenever Meta is having a slow quarter, they just raise their advertising rate and they lose almost none of their customers. They have almost zero churn. So their expectations for earnings is $32 a share in 2026 and $35 a share in 2027. And they've beaten Wall Street's expectations every quarter in the 10 years they've been public except 2. And they pretty consistently turn in 20% plus earnings growth. It's a global company. They have over 2 billion people on this planet checking into one of their platforms at least once a month, over 1 billion checking in once a week, and they have over 400 million checking in every day. So if you're an advertiser, you really can't find a better platform. And then they don't make you pay for an ad to go to everybody. They charge you to get in front of 5% of those people, but it's the 5% you want to be in front of. It's extremely cheap here. When everything's going great for Metasphere or Facebook, it tends to sell at 40 times earnings. When things are not going well with their Wall Street relations like they are now, they're at 15 times earnings. I was going to make this one of my favorite stocks for tomorrow's show. But since you did ask about this one, Sarah, and it is up $52 today, I'm sure you're having second thoughts as to whether or not to buy it. Don't. This stock is super cheap. This is giving Wall Street the confidence that they're going to be able to keep making over 20% earnings growth the next couple of years. My 2-year target on this stock is $1,300. Don't fear the up 50. It's up 50 because the smart money knows it's going to be up 200 in 6 months. So yes, buy Metasphere here. And thanks for joining us today. Hope that was educational, semi-entertaining. We'll catch you next week. Keep sending in your requests. Thank you.